So yeah, I mean, basically, ever since we saw the Chinese lockdowns back in reemergence of the Chinese lockdowns back in February, March of this year, combined with the fact that we've seen a very strong U.S. dollar, we've seen really all commodities, but we're certainly seeing it here in this chart, which is aluminum prices. They've come off from about $1.85 all the way down to $1 a pound. We've started to find a little bit of a bottom, it seems, and we've talked about some of the reasons why in the past, and we'll talk about it again today. But we don't yet see the evidence that really suggests that prices are about to lift off just yet. A weaker dollar could do that. A China reopening or lifting its zero COVID policies could do that. It is worth noting that, I guess it was Monday of this week, so just a couple days ago, there were rumors that started to fly that China was contemplating lifting zero COVID policies. The rumors had, and the headlines had the commentary centered around March of 2023 as being that zero COVID lifting date. I think the reason why that date was significant at the time or in the rumors was that that's basically when the new CCP administration gets into, that's when they essentially get into office. Pretty quickly, however, within a couple hours, Chinese officials came out and said, there's no truth to those rumors. But what we saw along the way was you don't see it a whole lot within these charts because we've just seen such large moves in aluminum over the last year. But there were some pretty significant moves in both LME aluminum and copper and nickel. Aluminum jumped up that day by probably 5% within a couple hours. Nickel, which I'll show you here in a second, jumped up by 10 to 12%. But when the rumors started to get dispelled by the CCP officers, things started to creep back lower. So again, until or unless we see a weaker currency, a weaker USD, or maybe some stimulative measure by China and a lifting of zero COVID policy, I don't think we yet have that real setup to see things lift off just yet. But that being said, one of the reasons why I think we're finding a little bit of stability in prices down around here is because of this chart, which says, and I apologize for those who've been on prior Cup of Joes, I just want to revisit this. Basically, what this chart is saying is roughly 50% of smelting capacity globally at current prices is uneconomic. They're not able to make that next incremental ton of ingot because energy prices are higher, labor prices are higher, whatever the cost of materials are is higher. So what happens when that occurs? Well, if you start digging into the marginal cost of production, some of these entities will start to shut down. And what you see is you'll see curtailments of supply. We've seen a little bit of that already within German markets, European markets more broadly, a little bit within China. But the deeper we go with an LME ingot price, the more of these smelters become at risk of closing. So I think that's why we're beginning to find a little bit of stability and a little bit of price support down in and around this area. I think it's really centered around this chart here. So keeping all of that in mind, if we do happen to see energy issues rear their ugly head again, natural gas prices in Europe double or triple, this chart becomes front of mind very much so again. And then on the Midwest premium side of things, despite the fact that we are seeing diesel fuel tightness, I will say that freight markets broadly, the ability to get a truck and get it to places is getting easier continually. And a lot of that centers around this notion that manufacturing markets are cooling both domestically and abroad. That tightness that was causing supply chain bottlenecks has, for the most part, eased. There is still a little bit of a looming risk of a rail strike. I still think clear heads will prevail around that, but it does exist. But as far as this chart is concerned, given the weakness in the freight markets from an availability of trucking standpoint, it does look as though the trend is likely to continue for now in Midwest premiums, which is lower for longer as we sit here today.